Okay, we'll take a look at lesson 2.4. We'll start getting into some algebra and variables, and we're going to do it through an exercise of looking at tax returns. And this might not be exactly what you're doing now. This is a now slightly outdated form, but let's take a look at the situation where we're going to start looking at this concept of variables, but we're going to do it in terms of taxable income, total income, adjusted gross income. So if you had to file tax returns, you will have a better understanding of this, or you might understand this faster. And so looking at this first situation, this is an example of a 1040EZ form where we have someone who makes a certain amount of income. Together they earn 93,000, had no interest or other income. That was how much they made. And so you would fill out a tax return like this, and then you would answer this question. If no one can claim you, enter 10,150. If you're married, enter 2020 and 30. And this is what's called taxable income. This here are kind of your write-offs or deductions the government allows, and there's so many rules to that, but in something very straightforward, there's a simple deduction for someone who's married or single. And so 72,700 is considered your taxable income, meaning that the government will calculate how much taxes you owe, not on the 93,000, but on the 72,700. So you're not paying taxes, you're not supposed to pay taxes on your full amount, and so that's what your tax bill becomes. So looking at this situation here, going back to some inequality notation, usually tax owed is looked up on a table, and so you have this table here. And then so thinking about if you have this situation, you would use the first line in the table if the taxable income from line 6 is at least 7,200 and less than 72,050. And so this is how much tax you should pay if you were single, or how much tax you pay if you're married. And so then that's how you determine if you owe or tax or not. And for this couple on the top, 72,700, you'd be using this here, and so they would owe $10,001 in tax. And now if during the year they didn't pay that much, then they owe. If they paid more in taxes than that, then they get a refund. So let's look at another situation here. The couple could calculate their tax based on this information here. A portion from the rate table, this is from 2014, these are called the rate tables. And so the rates you see on the right are called marginal taxes, looking at these values over here. But most people just call them tax brackets, but they're really called marginal. And so look at the calculation that's completed here. Use the tax rates above to calculate the couple's tax. Does it match the tax table? It's close. The value, our tax table was 10,001. So looking at this, let's take a look at how the calculations are done. And so if somebody makes a certain amount, the taxes, I forgot a number here on this. This is 18,001. Oh yeah, we're good here. The taxes someone pays on this table here is going to be 1,815 plus 15% of excess. Excess is how much more do they make above this number here, because they fell into this tax bracket here. This is how much money they made. And so calculating here in red is how much more they made, and then you take 15% of that and add that together, and this is their what you're going to call their tax. And so thinking about this number here, a commonly held belief is that marginal tax rate applies to all a person's income. It doesn't. Marginal tax rates apply only to excess, how much is more than. And so in this case, how much did this couple actually pay in taxes? And you take the amount they're supposed to pay, divided by 7,200, and you get 13.75%. And so it's not the 15% tax, but the marginal tax rate is on how much over you make. And those are called tax brackets. But we're starting to get into this idea of variables and what your taxes are going to vary based upon your income, which in this lesson we start, or in this unit, we start getting to equations and variables. And so before we do that, there's one last problem to look at here for the introduction of 2.4 is, here's another situation. You can pause and look at this here. But imagine you get, the couple gets 1,500. What happens is now they end up with 74,200 is their amount, and they get pushed into a higher tax bracket. And so that's what people say, which then means they get charged a higher marginal tax, 25% of what's over that. And so in this case, notice that 1,500 bonus actually requires them to have to pay more in taxes. Instead of 9,997, they're ending up with 10,000, and then 10,262. And so then notice again their situation increased their taxes, but because that bonus, they still brought in more. You could take a look at that. But that's it for this for the introduction.